I'm Philip Chandler. I'm one of the fund managers for the Schroders Stakeholder Fund, and I head our UK multi-asset team here at Schroders. Today, I want to talk to you about what's happened to markets so far this year, and what we think is coming up for the rest of the year and into 2025. Markets have had a good year so far, with global equities up nearly 16% in sterling terms to the 11th of October. In other words, that's the return you would receive as a UK investor buying global equities and reinvesting any dividends received. There's a couple of factors behind this bumper return. Perhaps the most important is that economic data has been better than expected this year. In the US, economic growth hasn't slowed as much as feared, so estimates of corporate profit growth remain very strong. But inflation has moderated as hoped. This has enabled the Federal Reserve to start reducing interest rates in the US. Stock markets like this, as it shows that the Fed is able to support growth into next year, whilst lower interest rates make equity valuations appear more attractive. However, this positive growth story has been stronger in the US than the rest of the world, with growth slowing worryingly in Europe and China flirting with deflation. Consequently, it's not surprising that US equities have continued to outperform, whereas stocks in Europe and Japan are up 7 to 8% year to date, and that's a good result. Emerging markets are up nearly 13%. The S&P 500 in the US has delivered over 20% in sterling terms. US equities have also been boosted by the AI or artificial intelligence theme that's been running around the world since ChatGPT launched in late 2022. Many investors are predicting that AI will be transformative in a variety of industries, and it seems a great opportunity for the big tech stocks like Microsoft, Meta, Amazon, and Google, who are spending billions of dollars investing in AI. But it's an even bigger opportunity for chip makers like Nvidia. These big US tech stocks have fared particularly well this year. Nvidia, for example, is up over 170% in dollar terms this year alone. On the bond side, the continuation of growth has undermined the attractiveness of fixed income. Whilst markets still expect central banks to reduce interest rates, thus making fixed rate bonds look relatively more appealing when compared to lower yields on cash, returns have been muted compared to stocks. Nonetheless, returns in excess of 3% for global bond markets year to date are nothing to be sneezed at, and it means that a multi-asset portfolio invested in both stocks and bonds has been able to post good returns, nicely in excess of the return you would receive on a typical bank or savings account. What about the future? And clearly it's important how economic growth pans out. If growth remains okay and inflation continues to moderate, then central bankers will have achieved the fabled soft landing of the economy. They'll be able to declare victory on inflation and continue to reduce interest rates from the elevated levels they've been at for the past 18 months. But if economic growth falters or inflation returns, then the picture will change. Indeed, the economic tea leaves are complicated at the moment. Growth in the US has been relatively volatile of late, but we still think it'll be okay, which bodes well for equity returns. Indeed, we've been overweight equities for most of this year, which has boosted fund returns even more. As to the rest of the world, there are new hopes for more government stimulus in China. For now, we think the effects will largely be contained to within China, but in the medium term, a stronger Chinese economy could help Europe, for example. On the flip side, if growth were to slow, then that would be good for bonds, showing the advantages of a diversified multi-asset portfolio. The economic situation could take many months to develop, but something with a much shorter time frame is the US election, which is only 3 weeks away on the 5th of November. As I'm filming this, the race still looks neck and neck between Kamala Harris and Donald Trump. But don't forget to pay attention to what happens in Congress, where some pundits are predicting that both the House and Senate could switch hands this year, which would be quite remarkable. This election matters as the two parties differ on tax, spending, immigration, and the environment, to name but a few important differences. What's really significant is that the US budget deficit is remarkably high. The US Treasury is having to issue a lot of debt to finance it, and neither side seems inclined to address the problem. That could cause significant worries in bond markets at some point in the future if there were to be a crisis of confidence. So something else for us to keep an eye out for. For now, we remain cautiously optimistic, but it's important to remember that investing carries some level of risk. Our goal is to protect your investments from economic downs or taking advantage of opportunities when they come up. We're here to help you navigate the investment market. Thanks for watching.